So good morning, guys. So today we will be talking about one of the most important analysis that is done in financial management. That is the risk and return analysis. Risk and return analysis is one of the most important analysis or a concept that you people must know if you are going for a core financial job in any of the companies. These companies would give you the stocks, their returns, and you people would have to calculate the returns, the betas of the stock, the covariance of the stock, the correlations of the stock, calculate the portfolio returns, calculate the portfolio variances, that is the portfolio risk or the volatility of the stock as compared to the index. This analysis has been formed a crucial part of the work done by the mutual fund analysis because mutual funds, we all know, is a combination of a large number of securities in a single portfolio. The securities can be from a particular sector, it can be from a particular country or a particular index. But to achieve the greater diversification, that is, to have more returns for a less amount of risk, or maybe for more returns for a given particular amount of risk, this analysis is very crucial. This analysis is taught as a part of curriculum in various undergraduation and post-graduation colleges as well. But still, a lot of students have doubts on how to solve the risk and return of these stocks and how to interpret them. So today, we would be talking about how to calculate the various factors affecting these stocks, their returns, their risk, and how to calculate them. So following is the Excel sheet presented in front of you. So the Excel sheet shows the actual adjusted close price of the following companies. For example, we have the company Infosys, we have Tata Motors, we have Dr. Reddy Labs, we have Bharti Airtel, and we have Nifty. So Nifty is an index as we all know. It comprises of all the top market capitalized companies. So Nifty can be in terms of Nifty 50, so that Nifty 50 would comprise of the top 50 market capitalized companies. It can be Nifty 100. So Nifty 100 would comprise of the top 100 most market capitalized companies. It can be Nifty 200 as well. So most in any of the cases, people try to take Nifty 50 because it is the best useful and we can say a good indicator which most of the companies are using because Nifty 50, as we all know, it is the most common indicator used in finance, right? So in this case, we have taken the Nifty 50 indicator. We have taken the following companies and we have the dates. So the dates has been taken. Following dates have been taken. You people can look on the screen. Okay. So these are the following stocks. So now the question arises, okay, that the following figures that have been noted down the Infosys, down the Tata Motors, down the Dr. Reddy Labs, down the Bharti Airtel. So what are these figures? So these numbers as we see, like for Infosys, for the first date, that is 1st July 2016, we have the value as 468.7064. For Tata Motors, the first value is 502.99. For Dr. Reddy Labs, we have the value as 2779.6. For Bharti Airtel, we have the value as 322. And for Nifty, which is an index, we have the value of 8638.5. So these are the closing prices of these stocks and the index as on 1st July 2016. Similarly, we have the closing prices on 1st August 2016. We have the closing prices on 1st September 2016, and we have been carrying it on down further till 1st July 2021. So all these are the closing prices. Now, how to find the closing prices? From where are we getting the closing prices of these stocks or the indexes? We can simply go to Google. We can open the Google tab. We can go to the BSC website, which is the Bombay Stock Exchange. So we have the first link for that. We went to the BSC website. Now the whole portal has been opened. We have home, the things about BSC, public issues, corporates, members. But at present, we are more concerned about getting to know the closing prices of these stocks. Because until and unless we have the closing prices, we would not be able to get the returns of these stocks, right? So let's type any of the companies. We have Infosys. So we took not the HCL one, we will take the main Infosys. Okay, we went here. So you have all the details about the Infosys. The current market price has come in, and the other things have also come in. See, we have the details about the company. You are getting the current market price, the previous close, and 52-week high and 52-week low. All these data you are getting from here. Market depth of the company, all that you want to know, all the information you would be getting from here. But our main concern is to know the closing price, right? So for that we can go to markets. You can go to the equity section. In the equity section we can go to the market information. You want to know about the market information, or in the equity section, in the market information we have the following information, the block deals and all that. The information is sometimes present in the market information, or it can also be present in the historical data. So we went to the historical data. Okay, when we went to the historical data, I'll just zoom it for you, because information either can be presented in the market information, but when the information is not present in the market information, we can go for the historical information. Because market information gives us more or less the annual reports of the company or the profit and loss statements of the company. But in this case, we are more concerned about the closing prices of the company. Now we have the second table and the second line which says the historical stock prices and what that we want. We went to the historical stock prices. We took the equity section because these are the equity stocks. We're not concerned with the mutual funds or the ETFs, or neither we are concerned with the debt, right? Now, like for example, we take the security as Infosys Limited. Now we want the data, like maybe we want the data like daily. We took some random dates. Like for example, like just for example, we took the date from 1st July 2021 to 1st of August 2021, and we clicked here as submit. Okay, so all this data has been downloaded. So similarly, you people can take data for monthly, you people can take data for yearly. Okay, so this, and if you want this data to be printed on Excel, all this data to be printed on Excel, because a copy paste thing might create an issue for you in Excel. So so there is an option below that kindly download the CSV file to view all records. So you people can click on the download button. The file would open like this. So these are the returns, and this you can arrange them. You can create a table upon that. But in all this, we would be just concerned about the closing prices and the dates. That's it. The opening high, low, the WAP, the number of shares, trading, and extra all the details we're not concerned about, because the returns can only be calculated on the basis of the closing prices. And of course, we want the dates as well. But make sure that when you are saving this file on desktop or like any feasible, the file has been saved as type is CSV comma delimited. Ignore the CSV comma delimited and save the file as an Excel workbook. Okay. If you're not saving the file, if you are not saving the file as the Excel workbook, like most of the important functions that you would be using in this analysis cannot be performed. So you would have to change the format from the CSV file to the Excel workbook format. Be sure it is Excel workbook only. It shouldn't be the Excel macro enabled workbook or Excel binary workbook. So make sure about that. Okay. So this is how we have calculated the data. Since we already have data, so I will close that file. Now, our first job is to calculate the actual returns of the stock. Okay, so how do we calculate the actual returns of the stock? That is, basically we have to calculate that how much has the stock risen or fallen in the next particular trading period. Like for example, our first trading period has been defined as 1st July 2016 and the second trading period as 1st August 2016. Okay, so we want to know that on 1st August 2016, how much has the stock fallen or risen as compared to 1st July 2016. Similarly, in 1st August, in 1st September 2016, we have to find out that how much has the stock risen or fallen or remained the same as compared to 1st August 2016. Similarly, on 1st October 2016, we have to find out that how much has the stock risen or fallen or remained the same as compared to 1st September 2016. And similarly, we have to do for all subsequent data. Okay. So first we'll do it for Infosys. Make note of one thing. The data or the returns that we would be calculating, the actual returns because we have the actual prices, right? So actual returns we have to calculate. We need to make sure that returns are calculated in this in the second row only. Okay, because if we are calculating here it makes no sense because we have no returns before 1st July 2016, right? If we have no returns before 1st July 2016, then how can we calculate the returns before that? No, na, it's not possible because we have to compare the returns of 1st August 2016 and 1st July 2016. So the formula goes in is equal to, we'll open the bracket, is present value of the stock or the current value of the stock minus the previous value of the stock, bracket closed, divided by again the previous value of stock. That's it. This formula goes in the current value of the stock, that is 452.12, minus the previous value of the stock, which is 468.70, divided by the previous value of the stock, that is 468.70. That is a simple method that we used to do in our school times, in our graduation times or college times, to calculate the change in returns. Okay, so this is the value we got. Now we would drag this value down for the Infosys, right? And same, we also want the same thing to be done for Tata Motors, Dr. Reddy and Bharti Airtel. So we would drag it for all of them till Nifty and double click. Double click for Tata Motors, double click for Dr. Reddy, double click for Bharti Airtel. I mean, instead of dragging it all around, the shortcut we can do as just double clicking it. Okay. So now we have the actual returns. So basically the figures are showing that how much has the stock risen or fallen. As we can see on 1st August 2016, Infosys stock has fallen as it is showing a negative return. Then on 1st September 2016, Infosys stock has risen as compared to 1st August 2016. That is why the figure is being shown as positive. Okay, and the same thing we did for Tata Motors and all that because we just dragged in. Now we have to calculate the expected returns. Now the question arises that why to calculate the expected returns if we have the actual returns? See, if you are analyzing a company, you would obviously have the actual returns of that company and that would be served to you on Excel or on any other BSc or NSC website. But obviously, when you are investing into the company, you would be also concerned about the future returns of the stock. That how much return the stock would give to you in future, right? If the stock is giving you more returns in future, the company has a good prospect, the company has a good growth in future, obviously you would like to go for that company. But if a company does not have any growth prospects, the company is into bankruptcy, the company is into spoilage, the company can go out of work anytime, then why would you go for that company even after the company has returned good returns at present? So for that, you need to know the expected future returns of the company. So for that, we have an inbuilt Excel formula that a very few people know. Okay, that inbuilt formula is the ln function. Okay, the log normal distribution function, which is equal to ln, and we wanted to find out the expected or the approximate future returns, because exact returns, like no stock market analyst can predict. So we want to know the expected approximate return. So we put in the ln function 1 plus this return, 1 plus this return, and we close the bracket. So we have the expected future return, and again we dragged it here. Okay, then again we dragged it here, and the same thing we did it, just double clicking instead of dragging it to the end as a whole. Okay, so we have the log normal function. It is an inbuilt function of Excel that helps us to calculate the expected return. Okay, the inbuilt function, though the expected return can be calculated through the CAPM model, which is the capital asset pricing model. It can be calculated through the dividend discount model. But the ln function is an inbuilt function that without any of the parameters and just using the actual returns, you people can calculate the expected returns. Okay. Now we have to calculate the monthly mean of all these. So for the mean, that is, we have to find the monthly mean returns. That is the average of all the returns of Infosys, Tata Motors, Dr. Reddy, Bharti Airtel, and Nifty. So for that, we have a simple function average. We open the bracket. Now we have to select all the returns. Make sure you have to select expected returns only, not the actual returns. Okay. So first we have the Infosys. We clicked here. Then press Control, Shift and Down key. Control, Shift and Down key. The whole of the column would be selected automatically. It's a shortcut. Instead of like selecting it wholly and going down, it's a shortcut. Then you can close the bracket. You have this. So basically, you people have selected all the returns of Infosys from top to bottom and taken out the average. Okay. So that is the one thing you people must be sure about. So all these things we are learning. We have the portfolio evaluation. Just a second. Okay. So we have calculated the monthly mean returns. Now I'll just zoom in for you. Okay. So now we can drag this Infosys returns to the other sectors as well. And we would get the returns, the average mean returns. Now it says to calculate the monthly standard deviation. Simple formula is equal to STDEV. Now the doubt arises, to use dot P or dot S, it does not make a difference because you have already taken a sample from that. So either you take the normal one or dot P or dot S, it won't make a difference because from the whole population you have already collected the sample, right? So we click on Infosys, again Control Shift and down key. This whole has been selected, right? Then we went here, we close the bracket, and we have the standard deviation. And again, you people can drag it here. Now we have to calculate the annualized mean or the annualized standard deviation. So first of all, we type here the annualized mean. And the annualized standard deviation. Okay. Formula for annualized mean. We have these returns. Now we have to calculate the annualized mean. So we can do simply this monthly mean into 12, because annualized mean you have people are calculating. So into 12. Okay. Now the people want to calculate the annualized standard deviation. So for that purpose, you have the monthly standard deviation into the square root SQRT function, right? SQRT function of 12, because we're calculating the annualized standard deviation. In terms of months, we are calculating. Okay. This annualized standard deviation we're calculating in terms of months. These annualized mean we're calculating in terms of months. But if it had said, okay, calculate the annualized mean in terms of days, then in place of 12, we would have used 365. If they would have said, use the annualized standard deviation in terms of days into 365, in terms of weeks into 52, in terms of years into 1. That's it. Now we have to calculate the weights and the weighted standard deviation, right? Make sure, but before that, we would drag the annualized standard deviation as well. Now we have to calculate the weights. Make sure that summation of all the weights, that when you are adding all the weights in the stock, right, the total must be equal to 1 always. If the total is not equal to 1, okay, so there is some mistake in your calculation. Okay. But before that, we need to find out the correlation matrix as well, right? So I would be separately teaching you that how to calculate the weights or the correlation matrix. But in this case, if you just assume that the weights are point 0.2 in each of the cases, equally like 20% has been allotted to all, though I would teach you how to calculate the weights as well. But in this case, because in most of the cases, the weights are actually given to you, at how much weight like this stock has in the total portfolio. Obviously, we need to see that the sum of all this should be equal to 1. It's 1 only. Okay. Now the weighted standard deviation would be equal to the annualized standard deviation into the weights. And we drag the same thing here. Okay. Now how to find the correlation matrix, right? So that comes a problem, that how to calculate the correlation matrix. You people have the formula for correlation. You people would be first finding out the covariance and then the correlation. So that would create a lot of time. Okay. So instead, there is a shortcut to find the correlation in one go. So for that purpose, like what can we do? We can go to this data tab. When we go to the data tab, we have the option of data analysis here. Okay. For those of you who would not have the option of data analysis, we can go to file, then we can go to options, we can go to add-ins, and there you have the Excel add-ins. And when you click on the Excel add-ins and go, you get the options of the analysis ToolPak, the analysis ToolPak VBA, and solver add-in. So your people can have a tick mark on all of these and can click OK. So once you click OK and go to data tab, you have this option of data analysis, right? And guys, so the second part of the video, we are learning to calculate the correlation matrix. So how did we calculate this correlation matrix in one go? In the previous session, we learned that how to download, that how to have this function, like when we go to data, that how to have the data analysis or the solver. Okay, we learned that. So a shortcut for that, that how to calculate the correlation of all the securities with one another at one go. Okay, so what did we do? We went to data analysis, we went to correlation. Now it says the input range. For the input range, select everything from the heading of Infosys, Tata Motors, Dr. Reddy, Bharti Airtel, and Nifty to all the returns. Okay, just do not select the headings of monthly mean, monthly standard deviation of total of 1. Okay, select everything. Be sure to label it in the first row, then press OK. So you have the returns, you have the correlation of the security from each other in one go instead of calculating the correlation manually. Okay, now we need to fill these cells as well, because here the values have come in a vertical manner, but we need them in the horizontal manner so that these cells are also filled up. So we would select this data, we would press Ctrl C, then click on the empty space. Do not forget to click on this empty space. Then we would go to home, to paste, to paste special, to transpose. Then we click on OK. So we have these values. Same we would do for the other one. Control C, clicking on this empty space, going to home, paste, paste special, transpose. Same for the other one. These values we would select Control C. This space is the empty one. Home, paste, paste special, transpose, OK. And the last one value, Control C, this on the empty space, home, paste, paste special, transpose, and C. So these are the values we have. Then we selected this whole table. Then we pressed on Control C. Then we went on this and we pasted it here as Control V. So we got the correlation matrix. Now, how to calculate the portfolio mean? Though we have the formula for the portfolio mean as weight of 1 into the returns of 1 plus weight of 2 into returns of 2. So that is feasible if we have only 2 securities or 3 securities. But in real life, you people would be having hundreds of securities, and how would you typing? Then how would you people would be typing that whole formula on the Excel? No. So a shortcut for that, you people can use the function as a sum product function. So it's an inbuilt Excel function, the sum product function. The first array you people can select as the annualized mean, the whole annualized mean. And the second array you people can select the annualized standard deviation. That is the whole standard deviation, right? You have this whole array, you clicked, and then you stop. You close the bracket, you have the portfolio mean. So you use the function as sum product to multiply this annual mean, this whole annual mean, into the whole annualized standard deviation, and you got the portfolio mean, right? Now you need to find the portfolio variance. Now again you have the whole big formula for portfolio variance. Weight ka square into the variance plus weight of 2 ka square into the variance plus 2 into the covariance of A and B. And if you people do not have the covariance, you have to do 2 into the correlation of A and B into the standard deviation of 1 into standard deviation of 2. That is all a bookish formula. But that is again feasible when you have just 2 securities or max to max 3 securities. But in real life, you people might have again hundreds of securities, and how would you calculate? So for that, we have an inbuilt Excel function, a shortcut, that is the matrix multiplier. This matrix multiplier. So for that, we have the inbuilt Excel function, which is MMULT, that is the matrix multiplier. So how do we do it? Again, this function is called an array function. Why? I would tell you. So we applied this function MMULT, right? We typed it. Then we selected all the weights. This blue one, all the weights. Then we put in the comma. Then we again wrote the function MMULT. Okay. Then we selected this whole table. Now we do not have to select the headings. We just have to select the values. This whole table we have selected as this red or pink one, as whatever you say. But now we have to select the transpose of the weights. So again, we have an inbuilt Excel function of transpose, comma transpose, and then we selected the whole weights again. Then we are here. Now, since we have opened three brackets before, we would compulsorily would have to close with 3 brackets only. So make sure of the number of brackets. Now, people might be wondering that why I have stopped here and not pressed enter. See, you people are using multiple functions at one time. Okay. This MMULT has been used twice. This transpose has been used once. So you people cannot simply press enter. If you people would simply press enter, then see, like what would you people have? Enter.